Hi, this is Obu and welcome to the third session in the Do Your Own Financial Planning course. In the past two sessions, we have covered a lot of things. Specifically, in session 1, we have calculated your net worth and also we have analyzed your income, inflow and outflow in terms of expenses, investments, loan repayments and taxes. In session 2, you would have identified your personal goals and also would have calculated how much you should invest monthly to achieve those goals. In this session, we will use the calculations and the analysis which we have done in session 1 and 2 to analyze and review your asset portfolio and also chart a plan for future. Please open the Excel sheet which we have been working on. In the previous sessions, we have created your personal net worth statement as well as analyzed your income inflow and outflows. And in the session 2, we have identified your goals and also calculated the amount of investment which you must do to achieve those goals. In this session, we'll build further on them, putting the data together to review and analyze and create a plan for future. So in this analysis, the first step is finding your investable surplus. So step 1, identify monthly savings after taxes and EPF deduction. Minus EPF. So average monthly expenses of your family. Let's say this guy is a single person living in Bangalore. Collectively, we can put around 25k should be good enough. In fact, if we look at his income details, expenses come around 22k, so 1000. Outgoing total loan EMIs $67,676. Insurance premiums you pay to 0. Children annual fees and other expenses 0. Currently we are not looking at ATC investments, we are just putting it on hold. We'll decide on later. Okay, this is 61,676. Let's say the insurance premiums are being paid from the annual bonus, so we reduce it from the monthly expenses. So this is his current outflow. So basically he's left with very few surplus you have. Probably you might get a higher figure depending on your flow and outflow. What we see from this step is most of his income is going into loan repayment and taxes. The next step is reviewing if we are adequately covered. Life insurance cover is only 5 lakhs. No. His life insurance cover as of today is 5 lakhs plus whatever the company provides, which is probably 1 times his CTC, which is still not sufficient. So probably 1 crore would do good. So you would still need another 82 lakhs of insurance, life insurance cover. And for medical, is covered for 4 lakh, which is decent. And for parents, he has taken a insurance policy, so which is good. And since he is not married, so in-laws isn't coming yet. The next analysis is to find out the emergency fund or the cash provision you have in case of any emergency. The total of cash, savings and accounts, this is automatically calculated. He has around 2,12,000. FDs in banks 0, other liquid investments 0. So currently he has around 2 lakhs which he can withdraw immediately in case of any emergency. Also, he can use his credit card to avail it at least to get a month bandwidth to cover any emergency expenses. The next step is viewing the goals and targets. So this uses the data from the sheet which I have analyzed. So his goals, total value of goals is around 5.58 lakhs, and out of which his total assets is 38,000. The value of his short-term goals is 8 lakhs and has a provision of 2 lakh cash. The remaining goals would go for the long term. So basically what we're trying to see is like what is the value of your goals in the short term and how much money you currently have, and what is the value of your goals in the long term and how much assets you have for the long term. So basically like the larger the difference, the higher the contribution towards that goal. You could also uncover the fact, like suppose you have your short-term goals are only 6 lakh but you have like 8 lakh cash with you, probably you can divert that to a long-term goal. So that's the whole objective of finding this. That's the objective of this exercise, to find out how much cash you have for your short-term goals and how much assets can contribute to your long-term goals. So these are the assets to be acquired, both short-term and long-term, and we also found out how much the SIP requirement for that. This EPF contribution adding the employer contribution as well, and whatever the surplus he gets, he's still short of 61,837. So that would mean only this much amount can go towards his investment, and most of his amount would be going for loan repayment. So this would imply that you won't be able to do much of investments post the loan repayment, and probably one way could be he could pay off the 2 lakhs which we have towards the loan, towards one portion of the loan, so that he can reduce the loan burden. Let's say if he could pay off his personal loan that would release around 10k cash for him to invest somewhere else. So that 10k along with another 17,000 he would be able to invest. And the final step is the review of performance of your investments. So his portfolio currently is cash 5%, then fixed rate investment 2%. Basically he has loans and real estate, so that's it. He doesn't have any other portfolio to analyze, nor he has any income to build his portfolio further. Probably what he can do is to reduce his loan by paying off his cash to release that income, that 10,000 EMI, to start investing. So instead of 7k he could invest 17k. So what he can do is he could use this cash to pay part of the loans, so that he could, let's say he repay the personal loan, and that would release around 10,000 rupees of cash which he can invest for his longer term goals. So 10k plus 16k, that 7,000 would be another 17,000 investment which he can do for his longer term retirement goals. We'll also look at more detailed projection or time-based execution of his plan. But for now, the analysis from this sheet reveals us two things. One, he is from step A, currently he is unable to invest because of his high loan payments. Currently he doesn't have much investable surplus because of the high loan payments. Then he would need, from step B we found out that he would need additional insurance, probably term insurance for his life. And step C, though he has emergency cash, probably he might have to rely on his credit cards in case of any emergency if he uses this cash for debt payment. And step D along with the goals and the personal balance sheet and income, combined it together, we would find out that the 2 lakh cash which he has, he can use it to pay a personal loan, to close off a personal loan, to release 10,000 rupees which he can invest for the longer term goal of retirement. And step E, review your taxes. Probably if he, let's say he invests in the EPF and PPF from the bonus which he gets, that would reduce his taxes. I guess this is already 47. Yeah, so from the bonus amount, if he invested in PPF and ELSS, that would decrease his taxes to 120,502, which means he would have around 2.5 lakhs left other than the cash expenses. 2.5 lakhs left for surplus as well as for his expenses, from which he can use to pay part loans. Review the performance of insurance, mutual funds and fixed deposits. He doesn't have any, but in your case you can look at whether insurance have given, how the insurance have grown. You can look at whether insurance has given you good returns, whether your invested mutual funds have performed as expected, and how much your fixed deposits are contributing to your asset portfolio. And also finally, you can look at your composition, like are you completely into fixed return investments? Do you have the balance? Is your portfolio is completely focused on only real estate or only fixed deposits? Does it have any risky ones like mutual funds or stocks, probably, which might increase your portfolio at a faster pace than real estate or fixed return investments? Overall, a good asset portfolio will have a mix of all asset classes, each with its own purpose to suit to your goals. That is the ultimate objective of financial planning. Once you finish the analysis for your financials, probably you would be able to come to the conclusions of how much you can invest per month and how much insurance you would require and how to provide money so that you achieve your goals. So basically to satisfy whatever goals you have listed. So you know the amount, the shortfall which you have against the target which you have, and then you can find ways to adjust. Is there any way to change your portfolio, as in can you sell part of folios in, can you convert one part of your folio into another so that you achieve your goals. So I hope in this session you would have got more clarity in terms of how much investable surplus you have, whether that can help your goals or do you need to do any rejig of your asset portfolio. So all these questions would be thrown up. You could just think about what you can do, and in the next session we'll create an action plan so that we do all this. So basically we will adjust the asset portfolio, or else we will decide what we should do to achieve the goals, and also we will do projections. We'll do time-based projections where we create a clear plan, as in time-wise we'll be investing this much, and then our assets will grow in this fashion, or our liabilities or loans will be closed in this fashion. So basically that would provide more clarity as in how to achieve your goals, and most importantly it will clear the confusion in your mind as in how you will find money for a particular goal, whether short term or longer term. Again, feel free to contact us at help@MoneyOwl.in or at our mobile number 90086279193 if you have any issues or if you need any help with respect to your financial planning. See you soon in the session 4.